once you see.
Okay, we're going to call to order the Council of Revenues March 7th, 2023 meeting on the general fund. Dr. Kobe, has there been any communication to the council and any
No.
public comment?
None.
Okay. So we'll hold on for a few moments to see if anyone wants to comment or communicate anything to the council.
And just as a reminder to everybody, if somebody would like to communicate with the council and make public statements, please write those, indicate so in the chat or the Q&A. We will tell you.
Yeah, can they raise their hand if they, to let us know if they're working, they're typing a comment? Yeah.
Yeah, we're monitoring that.
Yeah, we can wait for them. So I don't see anyone raising their hand.
Oh, yeah.
I'll assume that no one's working on a comment.
Yeah.
Okay. Okay. So we did not receive any communication to the council or any public comment. The next item on the agenda is the minutes of the meeting of January 5th, 2023. And we just got an updated version, right? A few minutes, I think just recently. Do you know what changes were made, Dr. Kobe? Is it?
I don't. It was Marilyn made the changes, so.
Marilyn, can you summarize what changes you made? If it's just typo.
Yes, there were some grammatical errors, and I just added a little bit more about what I had said, which was that most economists were expecting a recession in 2023, and the Japanese visitor arrivals, because of the currency exchange rate for the yen to the US dollar, that is much weaker for the Japanese yen, less likely that the Japanese would be visiting Hawaii soon, because it was almost like a 25% decrease in the yen value compared to 3 years ago. That's basically what it is. So you'll find more people traveling to Japan rather than vice versa, I think.
Any other council members have any comments or about the updated version of the minutes?
I move that we approve.
I'll second.
Okay. Okay, take a vote on approving the updated minutes. Vice Chair Niwal.
Aye. Yes.
Dr. Sutherland,
Yes.
Dr. Bonham,
Yes.
Councilmember Maynard,
Yes.
Councilmember Hayashi,
Yes.
Councilmember Lee.
Yes.
Okay, so the updated minutes are approved unanimously. Okay, next is Dr. Kobe. You're going to present.
Yeah, I can do a quick presentation.
That'd be great. And this is based on the email with the two attachments, right? You said.
Yes, correct.
Okay. Okay. Please go ahead.
Can you see the presentation all right?
Yes.
Okay,
Yes.
great. So just as a reminder, there's a bunch of things happening, and one of the most important things happening is the constitutional refund, right? The constitutional refund is essentially, up till now, there's been $311 million, $312 million in dispersals up to now thus far. We're going to see how things were dispersed, but generally the bulk of this occurred in September and October, and there's been a little bit of a trickle, less than $1 million for the subsequent months. But that is one of the main things that is disrupting or complicating our calculation of the general fund revenues, and we'll go over that more in detail. But generally that's amount, and we're talking about, if we're comparing it to fiscal year 2022, that's about 3.3% of growth.
Mm-hmm.
Right? So these are the numbers for this month, right? So you should recognize this, and it should look like pretty close to the preliminaries that you've seen in the beginning. I want to highlight a couple things. One is the GET is coming in strong at 13.2%. And the other kind of very big consumption tax we have is the TAT, which is up at 24.4%. Right. So in those two areas, it looks like consumption remains relatively strong.
Seth,
Yeah.
just to follow up, GE has been relatively stable at around, the high or low teens, right?
Yes.
Okay.
And it's been relatively stable for about that, right? It keeps coming in around between, the low teens.
Okay.
So the one thing that we are still working on is the individual income tax, right? So we wanted to understand what is going on with the individual income tax. So the first thing I did was I removed the constitutional refund, right? So if we remove the constitutional refund, we go over here, individual income tax is still down 2.2%. And if we adjust the total general fund revenues, that would be 6.8%. Right? So the big question is what's happening with individual income tax? There's two things. There's a big decrease in the declared estimated taxes. This is something that has not.
It's gone down, right?
It's gone down, right?
12.6%, right?
Yeah, it's gone down 12.6%. This is something that we saw and I brought up in January meeting. It's been happening all year. It gets aggravated even more because December is a big payments month for declared estimated taxes. This is something that's been seen all around the country, including with the IRS, right? So there's a couple proposals. Ideas here. One is the stock market is not performing just as well. So the estimated tax payments are lower. In fact, that seems pretty close to what we've seen because the states like New York and California that actually depend on even higher levels of capital gains, their taxes, tax revenues are even more, individual income tax has been more volatile. The other option and hypothesis that we have to consider is inflation is eating away at earnings of the S corps and the partnerships, and they're showing up in terms of the declared estimated taxes because they are the bulk of these people.
All the sole proprietorships and pass-through entities like S corps partnerships, they pay their tax through estimated income tax.
Yeah, exactly. So
Yes.
it is possible that they just don't have as much income anymore before. We don't know whether it's the capital gains theory or the inflationary pressure on earnings of pass-through organizations or something else. But we do know that declared estimated taxes is lower. There's another key.
Is the federal also seeing
Yes.
estimated taxes?
Yes.
Mhm.
And
So,
then go ahead.
There's another thing that's going on here, I think would be showing up in estimated taxes is the 45% drop in home sales year over year. So through January, or actually it was January versus a year ago. This is true nationally as well, but it's a little bit bigger in Hawaii. Nationally, I think we're down about 35% year over year, and the Honolulu data for January I think was 46% decline. And that's true. It's pretty much the same on all the islands.
Yeah. And you can actually see this in our taxes down here. So this negative 12% includes the conveyance tax, and it's collected by other departments. And what you can see is we're about, conveyance tax is not collected by the Department of Taxation. So that's why we include it in this line. But we're down to at least 100 million in conveyance taxes, and that doesn't include capital gains. So that really supports Carl's argument right there. The other thing I just didn't want to bring your attention to is with this, we've divided out between constitutional refunds and other refunds, right? But refunds are up 33% on the year. So, that conforms with this hypothesis that people's tax liabilities are just slightly lower than they thought they were going to be in 2020, 2022. So that
2020, because 2021, I'm sorry, 2021, because the refunds would have been issued by October. If they filed an extension, it would have been October 2022.
Okay.
I don't think too many people the early filers, people, that claim a lot of the credits, or they file early. They might be claiming some of the refunds, but I think there's the more complicated returns haven't been filed, they're going to, I think, get filed closer to either April 15th or even many of them go on extension.
Correct.
Seth?
Mm-hmm.
I had a question with regard to non-resident withholding on sales of real estate. Where would that go
HARPTA.
on? Yeah, HARPTA. Where is it going on the schedule? Is it going under declaration of estimated taxes?
Yes.
Okay, so yeah, there's been less
As far as
sales.
Yeah, let's harp that, right? Because of what Carl said,
Yeah.
and it says less real estate
Well,
transactions.
yeah, I've seen less real estate
Yeah.
sales.
Also,
I
if it's found 100 million, that's an indication.
Yeah, I think it's there. I'll have to go back and check because it might be under taxes withholding, because it is a withholding tax. So I'd have to go back and check. Actually, Marilyn.
Okay,
Um,
yeah, because it says wages, so that's why I was-
Yeah, withholding.
Yeah,
But bottom line, the other thing that's it's interesting to show that is withholding tax on wages is up 6.8%, which is the biggest part of individual income tax always. And it seems relatively robust, right? So
yeah, it's really pretty amazing. I guess so. This is a fiscal year basis because the calendar year income's down 2%.
Yeah.
Through the third quarter of 2022. So I guess we're only capturing that first quarter of the fiscal year in known income.
yeah, is that including transfer
That's
payments?
That's total personal income. Yeah,
Yeah.
including transfer payments.
Yeah.
So on a year-over-year basis, first fiscal quarter was up 1%.
But fiscal year 2022 or calendar year 2022, you said is down?
Through the third quarter is down 2%.
And most of that is transfer, withdrawal of transfer payments?
It's almost entirely in transfer payments.
Yeah.
If you look at earnings by place of work are up 6%.
Mhm.
Yeah, so transfer payments are down almost 25%.
Yeah, so that's not unexpected given the volume of transfer payments during the
No.
COVID period.
No, it's not.
Right.
But the 6% increase in payments with withholding taxes on wages, or 7%, is that's interesting. But that's
Mhm.
actually consistent with the strong job growth that we saw in the summer, and actually into the fall. So
Right. And wage inflation.
very limited. Not unless you work in food service.
Okay, so let me keep going if you guys
Yeah.
don't mind. So I just wanted to show you like the overall general fund collections by month. The orange line is fiscal year 2022, and then the solid line is the actual things, actual collections month by month, and then the dotted is fiscal year 2023 adjusted for the constitutional refund, right? So we take the constitutional refund and add it back in. We went over this in January, but essentially I'm going to say the same story is, in September and October, even in November, it really made an impact on our overall collections, and now it's drifted off. And you can see in January and February where we're missing the collections actually is they're in the January is the month where you see lots of declared estimated taxes. So that's really starting to drive our collections and bringing it for a little further down. So one of the challenging things that you guys are going to have to decide for this meeting is how is that going to affect April collections,
Right.
because April collections have always been large, but our declared estimated taxes is lower. Usually there's a decent correlation between declared estimated taxes and April, but we don't really know what's going on. So that's just kind of like one of the things that you guys are going to have to decide for this council meeting.
Because April 2022 was a record high collections month, right?
Correct.
Correct, yes. Basically 1.4 billion.
Yeah, so it was really high. This is just to show you the GET, Kurt. Like it's been pretty steady all along. So you can, sometimes we can get distorted with this, but essentially there's more than 2 bars in between the GET, pretty consistent across the board, right? So GET collections continue to be strong and elevated.
So that 2 bars is about 10%.
Yeah,
Maybe
a little bit more.
The average was 13% for the fiscal year to date. So we're talking roughly 30 million extra GE collections every month.
Right, in a normal year. And then like in sometimes like January and April, those are even higher because instead of we normally get 350 million, we'll get 500 million, and 10% of that is 50 million, so it's 30, but yeah, that's correct. So here are the declared estimated taxes. I just wanted to like, these are the questions that we're trying to work out, right? So you can kind of see the declared estimated taxes. We're about the same. We would expect the fiscal year 20, we usually expect the given year to be slightly above the previous year, but they were, for the September, they were right on point, and then they've dropped below in January, and even in February, they're a little lower. Hard to see, but this is the question, right? And so the question is going to be like, what's going to happen in April? These are total refunds, right? And so the orange line is fiscal year 2022 all the way through. This is with the solid line is with the constitutional refund. The dotted line is without the constitutional refund, right? So I took out the size of these constitutional refunds. And what you'll see is, we're kind of expecting, you know, the early filers, if people are getting their returns, are filing more, and their refunds are slightly bigger and growing compared to everybody else. So that's what's going on with the refunds, right? And this is just your kind of like quarterly reminder of last year, the last meeting, you guys are at 5.5%, 5%, and then goes down to 3.5%. This is what you're doing. This is how the mean forecast with and without the constitutional refund, according to all of you guys. So you're at 6.4% with the constitutional refund and 10% without it. And these are the models, right? And then because of the constitutional refund, you have some like switching around because you have the higher or the lower base. That's something to think about. I won't go over this too much, but like we do include this. This is kind of like, again, a nice little check to see how the models correspond, especially when you put in the correct individual actual economic indicators, right? So the actual economic indicators, when you put everything in, are for last year was 29.5, which means that we're off by 0.4, right? And then these are the council's distributions. They were 28% in May, going back to it was a little bigger in September. And then these are the models, right? So you can see the models, especially when you guys are pretty good at like predicting it. It does okay. And that's just a reminder. This is like another helpful chart, right? I know construction is already in this, but construction is moving it. So if we wanted to add construction in the future, we can. But this does just kind of point to you, or like what kind of levels of growth do you guys think is going to happen? And this is with the constitutional refund. So I think we're somewhere in like this area right now with the actual indicators.
So, I know the impact of the constitutional refund is going to get further diluted for the rest of the year. But do you know what we have to average for the last 4 months of the year to hit the current council's estimate?
I can do that for you in the next couple of minutes and get back to you.
So what is our current estimate? 5.5?
5.5.
And we're at what, 1.3.
We got to be
1.3.
Yeah, I sent you the
over
calculators.
11%.
How much?
Over 11%.
From a record collection month too in April.
Yeah,
it's just a little bit under 12% to
Yikes.
reach 5.5.
Jack, you're muted. Or we can't hear you at least. Do you guys have any more questions about the constitutional refunds or anything like that? If not, let's kind of,
Well, Seth, is that expected that we'll have another constitutional refund this next fiscal year? Do you have,
I don't know. There's a bill out there for a constitutional type rebate, but I don't know.
yeah, a long time ago, we used to have it just about every year.
Yeah,
Yeah, $1.
Some years.
Some years it varied.
Can you guys hear me?
oh, now
Yes.
we can.
Okay,
Yes.
all right, thanks, sorry. So
And
anyway.
again- Yeah,
Carl's
and
point-
again, I sorry, I sent you the calculator so you guys can put in the calculators with that email, and so I'm done.
Yeah, and I looked at that, and as Carl said, we need about 11.6% growth for each of the next 4 months in order to reach 5.5 after the constitutional rebates been or constitutional refund has been included. And that's 11 point something on a really high April, which
Yeah.
I'm not sure that we can repeat.
So-
Yeah,
So
Looks
the way that I look at that calculator is, we had a forecast of 5.5% for the fiscal year, and obviously the first half of the fiscal year is all distorted by the constitutional refunds, and we can back them out, whatever. But that was basically our view of what we thought the underlying economy was going to generate in
Right.
tax revenue growth. So my inclination when I first opened the calculator, it was one of the first things I looked for was, okay, let's plug in 5.5 for the rest of the year. That's what our forecast was, and
Right.
that gets you a number down in the 2s or 3s for the full fiscal year.
Mhm.
And I don't have any reason to think that we're going to post numbers a lot higher than 5.5 for the rest of the fiscal year.
Mhm.
It's interesting though, Model 1 is, my forecast in Model 1 is by far the highest. So my inputs generate 8.6% in Model 1 for fiscal 23. I have no idea what everybody else is thinking, because our forecast for the fiscal year, or excuse me, for the calendar year, is that 2023 is really a slow year. So I'm not sure what. My guess is it's construction, because we are seeing those construction dollars that we've been talking about. We saw a big jump in construction job counts at the end of last year. I want to say it was hundreds of jobs, something that we didn't expect until really later in 2023 and into 2024.
I've been just happened to be talking with some architects and contractors, and they're actually having trouble keeping their crews working because they can't get permits approved through the
Yeah.
city. And they're really struggling trying to figure out what to do. So,
That makes sense. Every meeting you go to, that's the topic of conversation, is how horrible the permitting process has become. It's like it's even gotten worse, if you can believe that.
yeah, that's what I'm hearing. It's gotten
Yeah.
worse.
the other thing I've observed here is that when we had the pandemic, there was a lot of renovation work being done to all the hotels. That's when everybody just closed down the hotels or just had a portion open, and they hired the contractors, and they did a lot of renovation work. So now when the tourists came back, they came back to renovated hotels. And I think a lot of that work now is no longer here, since the tourists are now back and the renovation work was done. And it seems that the work now has slowed down.
Well, that's not consistent with the data, so maybe the data's wrong.
So that's not consistent with what we're seeing either, Marilyn. So from I think, you know, with those renovation jobs, yeah, that stuff is dropping away, but there's quite a bit more of development that's happening now. There's a lot of large infrastructure as well as military projects that are kicking off. So the construction industry is fairly busy right now. I mean, it's hard to find people. Now permitting is the big issue. I think it's actually construction is probably the bigger issue, but from a design perspective, a lot of the engineering firms are extremely busy right now.
So maybe it's a different kinds of construction, maybe the infrastructure, the grading.
I'd agree. Yeah.
Those
I think some of the smaller private
contractors
development, I think that's starting to slow down. I'd agree, but I think that's what we're seeing, and that's what we're hearing throughout the industry is the private development is starting to slow down primarily because of interest rates. The interest rate increases is causing construction costs to go up. You know, their borrowing costs are going up, so they're putting pauses on some of those projects. So Marilyn, that might be what you're referring to and what you're seeing. So from that perspective, yeah, I think those things are happening, but the government and agency work is kind of filling that vacuum right now. It seems to be kicking in, and there seems to be a lot of work on the other side.
Yes, so it maybe a different part of the construction sector is busy, and the rest maybe in construction for renovations and new homes or stuff is a little slow right now. And things have been slower because
I'm sorry. Go ahead, Marilyn.
things have been slower because of the permitting process here. So I agree with Chrissy that.
Dr. Saito, you raise your hand.
What are people assuming about inflation in their forecast? You know, I've got a little over 5% for 2023, fiscal 23, and then dropping down to 4 and 3.5 and then 3. So I'm just curious where other people are coming down on inflation.
I said 6.42. I had confidence the Fed wouldn't get something done, but I don't know.
I'm still trying to find my forecast in these handouts. I guess I could go and look where my actual.
And the reason I'm asking is that if we assume 5.5% as we did in our last forecast, and assume 5.5% for the rest of this fiscal year, you know, just as an indicator, you know, a lot of that could be inflationary impact. It could be almost zero real.
So the forecast that I submitted was 5% for fiscal 23 and 2.3% for fiscal 24.
Wow.
I don't think most of you realize how fast inflation has already fallen in Hawaii. So if you look at the 12 months of inflation to January, it's 5.2%. If you look at the annualized 6-month inflation to January, it's 1%. And most of the things that people are talking about, I mean, we actually have prices falling. So in the CPI in January, we had actually in the 6 months to January, rents fell, and food and beverages are totally flat. New and used cars are down, gasoline's down. The shelter component barely grew at all. So I think we're going to be pretty surprised by how weak the inflation numbers end up being, particularly in next fiscal year.
I think it's interesting how slow the housing component of inflation is to adjust, because certainly prices of homes are coming down rather substantially. Second month in a row that we're under $1 million in a median price for a single family home, and rents are falling. But I believe the way they calculate the inflation in rents, it's when the contract renews. So if you're have a 1-year lease, the fact that new leases that are coming in at a lower rate doesn't get impacted in the calculation until the lease you're in actually renews. Yeah.
So what I was referring to, so what you're saying is right. So the BLS is not measuring market rents. They're measuring the rent that the typical household is paying. And, and some half of those people are in owner occupied homes.
Right.
And so their rents are going to be, their imputed rents are going to be more stable anyway. And the people who are not in owner occupied homes, so a fraction of them obviously are not renewing a lease. Their rent's not changing. And so the market rents actually still aren't down year over year. So according to the data that we track, the growth rate is down from 12% to 5% on a year over year growth rate. So they haven't actually turned negative, but the number I was referring to was actually the rent component in the consumer price index had actually turned negative during the last 6 months, which was kind of surprising. The data is incredibly noisy.
Yeah.
And I mean, so nationally, I think we'll be surprised by how fast inflation comes down nationally as well. And the bond market can freak out every other week about whatever they want to freak out about. But we've had a couple of months of data. We had the January data, and then we had some revisions to the 2022 data that made everybody start pulling their hair out about inflation. But I think by the time you get to summer, when those declining rents nationally start showing up in the CPI, those numbers are going to come down pretty hard. I think our forecast for the year over year for Q4 nationally is 3.5%, and for Hawaii, it's sub 3%.
Is that fiscal or calendar?
Calendar year.
Calendar 2023?
By end of calendar year 2023. Yeah. So by the time we get to the end of the year, we think nationally will be under 4% and Hawaii will be under 3%. And who knows if we're right.
I think the Feds just announced today that they felt that they had to have a stronger, a faster rate increase because of past data, a lot of jobs, a lot of economic activity, and they have to raise the interest rate a lot, either faster or more. And so the stock markets went down quite a bit because of that. And so I'm not so sure that we have tamed inflation yet.
Well, we'll see. I mean, what Jerome Powell is talking about was whether or not when they meet in their next meeting, they're going to raise their forecasts for the terminal Fed funds rate and whether they're going to raise their forecast for inflation and other things. And they haven't met yet. They're meeting 22nd, 23rd of this month. And we've got 2 data points that are coming out. Actually, end of this week, we get the jobs numbers. And then next week, we get CPI numbers. It just strikes me that the people are getting all excited over a couple of months of data that is completely polluted with seasonality. And I mean, basically all the data systems are broken. And particularly with seasonality, it's really wreaking havoc. So it's hard to read the inflation numbers. I wouldn't argue with anybody that inflation is going to be a little higher or a little lower. But the bottom line is that the bond market has finally woken up to what Jay Powell and others have been saying for at least 6 months. It's pretty funny to go back and look and see what the bond market said 8 months ago, 9 months ago, right? They were thinking we were going to have a terminal rate of barely 5, and then rates were going to start falling by summer. And now they've got a terminal rate closer to 5.8, 5.7, 5.8. And actually, the latest data on Fed funds futures says we'll still be above 5% at the end of 2024, or right at 5% at the end of 2024. I think it was 4.8.
And their reasoning is that inflation is going to be more persistent than what we had originally thought.
Their reasoning is we had 2 months of inflation that didn't come down so fast that it satisfied their excess optimism. I don't.
Well,
I think,
as you say, we'll see.
Yeah,
we will see. And I think it's the fact that Paul came out and spoke the way he did. I mean, after decades of reading Fed speak, I think he's indicating that they are not going to do another 25, but instead are going to do 50. We, as you say, we
We'll
will
see.
see on the 22nd. We will see what they actually do. But usually, he doesn't come out and say something like that unless they have decided, or unless he feels that they need to raise rates more. I think you're absolutely right, Carl. A couple of months of data have people really concerned. The January jobs report was very strong, unexpectedly strong, but there are all sorts of seasonality things that come into play. Weather.
The January jobs report's wrong. There's no way that's the underlying growth in jobs. It's just
huge.
Anyway. Yeah, we could do a
Obviously,
side bet on whether they go to 50 basis points. I'll be surprised, and I think it would be a mistake. I think it would be really pretty. Anyway, it's fun to watch.
Agree with you, Carl, that the Fed has, they were very late to start, and they may overshoot as far as that goes, and the economy is going to come down, slow down maybe faster than what they would like. Yeah, that's my fear.
Yeah, my fear is that they're going to go too far too. I mean, the U.S. Treasuries now for 2 years is over 5%. So people are switching.
I hope you got a high yield savings account or money market account.
Yeah,
I can recommend one.
Oh, okay. Let me know.
I'll send you an email.
Okay.
The 10-year is under 4, so that
9.9 something. Yeah.
The 10-2 spread is really quite wide.
That's actually a record. The 10-2 spread.
Is trying to get a word in.
Just hit a record today.
Yeah, I'm trying to call on Dr. Saidal.
I assume that we've moved the agenda into the discussion of forecast 2023.
Get into the forecast.
And if that's the case, and going back to this kind of benchmark that our last forecast was, if we assume 5.5% for the rest of the fiscal year, we're going to get a number of 3.1% for the entire fiscal year. If we assume 5.5% for all of the months except for April, and assume April is equal to the record that we had the prior year, then it's going to be 2.2. So I think that in both cases, our assumption of our prior forecast for 2023 is, I think, on the high side.
Thanks to January and February.
Yeah, well, and I think it's logical that we if we didn't expect it, we should have expected that there would be a slowdown. That this injection of liquidity associated with the COVID period, at some point, has to reverse itself, and that are going to be consequences associated with that, and maybe that's what's happening in the January-February period, is that we're kind of returning to a more normal situation from a pretty abnormal situation.
And also the inflation has dropped a lot faster than, as you indicated, Dr.
Well, so Carl believes.
Yeah.
Well, the measured inflation in January was 6.4% nationally, year over year, and Hawaii was 5.2, so down from 7.5, and down from 9% in the first 6 months of that annual period. So it has dropped dramatically.
Okay, so anyway,
so you have a number?
Somewhere between 2 and 3.
That's what it sounds like.
I'll move 3%.
I'll buy 3. I'll second. By the way, Carl and I were the first, the mover and second on the 5.5 last time. So, according to my reading of the minutes.
Any further discussion at 3%? Well, Carl, what did you say?
This is 3% after the rebates, including.
Yeah, at the end of the year, this is a real number.
Without that, it would be 6.
It would be 7, right? Isn't it?
6.3 because you add 3.3%.
Is that the impact? Does 311 million?
Yeah.
It's not, so general fund's about 80 million.
Oh,
I mean,
90 some.
or 9 billion. Oh, okay.
Yeah, remember we're at the 10 billion range now.
22 is 9.3 billion.
Sounds like a lot.
It is until you start reading the Wall Street Journal.
Last April? Was it $1 billion last April? For the
It
month?
was 1.4
No,
billion.
it was $1.4 billion last April.
I
Up
think not-
from $1 billion, up from $1 billion the year before that, up from, oh, good God. 2019 was 800 million.
Because last year we ended at 29, right? 29% growth rate, which was that's extraordinary. It's 29%.
Well,
Mike,
April 2022 was up 40% over April 21.
Yeah, well, January, February, and March were all up 35 and above. Right.
Mhm.
When you look at it in the context, and actually every month that year was
Every month that year was
35%
huge.
plus until you get to May and June.
Right.
And
then we open up.
So the base, you're saying the base that we're comparing to was really high. It had grown a lot from the previous year. But the previous year was,
well, it was compared to the pandemic.
Yeah. I think it's a bit optimistic to think that we're going to grow 5.5% from that record April. So my inclination would be for a lower number, maybe more like 2.5 or 2, because I think it's going to be really hard to beat the record high 1.4 billion for April.
Well, if you assume 5.5 for all the months except for April and assume 0 for April, you get 2.2.
but even to hit 1.4 billion again would be extraordinary.
So I think something like, I'm trying to read my tiny writing over here, but I think something more like 2.5 is more reasonable, and we'd be lucky to get there given how high April was last year.
Was there anything, I mean, I can't recollect why it was so high last April? What was the unusual thing? Sales of property or?
Coming out of COVID.
Yeah,
I think it was individual income tax, wasn't it? So
Yes.
we just had large collections, and of course, trying to remember, high stock market prices. So we had a lot of capital gains.
Oh, yeah. Yeah, stock market.
We're not going to have that. Yeah.
I wish.
No, we're not going to have that.
Yeah, Seth, you talked about that earlier in your presentation, right?
Yeah,
Yes.
You guys, are there any national patterns about this? Was April unusual?
April was
for us
extraordinary
or
high for
others?
everybody else.
For everybody
Right.
else?
We're pretty good at following, at least the individual income tax states.
So, I mean, so last April, the declarations of estimated taxes were 40–50% higher than the previous year, and they were more than double what they were the year before that. If you go back all the way to 2019, it was 190 million, and in 2022 it was 500 million.
Oh.
So
That's more than inflation.
I mean,
Oh, yeah.
if you so I think even just assuming 0 growth for April may be too optimistic.
Okay, so now we're going below 2.2.
I would feel more comfortable with the 2%.
Well, 5.5 for all the months and -1 for April is 2%. It's 2.1%.
So that means April would be 90% of 1.4 billion.
Yep.
Any other comments?
Well, what do we have? What do we move?
We moved 3. I'll amend my motion and make it 2.
I'll second that amended motion.
No, I have to.
I think Jack has to do that.
Oh,
Or
okay.
we have,
okay.
or we have to start over.
Please. I will do it. I'll amend.
And we have a second, Jack.
Jack seconded.
Oh, Carl. Oh, Carl.
Carl,
Jack seconded. Carl made the motion too. Any comments, Councilmember Lee and Hayashi?
No,
Okay. Any comments, Councilmember Niwal?
no, I think it's reasonable
Okay,
at the 2.
so we'll
Yeah,
take a,
yeah.
this is the,
My eyes are popping too.
yeah, this is the, a vote on the council's estimate for fiscal year 2023 at 2%. Vice Chair Niwal,
Yes,
Dr. Sadat,
Aye.
Dr. Bonham,
Yes.
Councilmember Maynard,
Yes,
Councilmember Hayashi,
Yes.
Councilmember Lee.
yes,
Okay, so the vote carries unanimously at 2% general fund growth for fiscal year 2023. Okay, who wants to start the discussion on fiscal year 2024?
So since I had such great luck with fiscal 23, that was actually 2.25 was actually the forecast from our model for fiscal 2023. Forecast from our model for fiscal 2024 is 4.5.
And
But
what
I'll suggest 4. I won't make a motion. I'll just suggest it for conversation.
isn't that the period that the recession is expected? You know, they pushed back the stated recession period.
So in our so basically most forecasts right now, and we'll all be wrong, are for a very mild recession that starts second half of the year. Right? When UHERO first started forecasting a recession nationally, we actually thought it would start in Q1. And we've pushed that back because of, the strength of the US economy keeps surprising. And, some people are actually starting to push into 2024. But I would say the consensus is for a pretty mild recession. And so like our forecast that has a recession in 2023 still has 1% or 0.8% GDP growth for the whole year. So it's quite a mild recession, and we don't have a recession in our Hawaii forecast,
interesting.
but we have a pretty marked slowdown. And I think I noticed DBED came out with a forecast today that just keeps going up, up, up. I just saw the headline that said that Hawaii's economy is going to outperform the US economy according to their forecast. And then we're going to get to 10.5 million visitors by 2025, which is totally impossible. It's not totally impossible, but it's highly unlikely.
Yeah, I kind of questioned that if we have other vacation destinations that are benefiting from the foreign currency exchange rates, and it would provide a less expensive alternative to Hawaii. Maybe I'm kind of biased looking at the hotel rates here on Maui, but
Yeah.
I mean, over $1,000, and it's
That's
huh?
I don't know.
The average is not over $1,000, Maryland.
Yeah, the average is not over, and we
600.
Maui has had a lot of these corporations bringing their employees over and paying for their airfare and paying for everything. So that I've noticed that on the airplanes that they're flying over because the company paid for their trip, and I'm not sure if that would continue if interest rates go up and companies are doing less well. So, I mean, I understand where Maui is. I mean, I think I mentioned on Oahu, I think the Japanese are going to think twice about coming over because of the price. And then the second thing is there seems to be a lot of crime there. this is me from reading the newspaper here, what was happening in Waikiki and all. And
Yeah.
so those two things would, to me, dampen tourism on Oahu.
Mhm.
So the number that I was throwing out was coming from, it's our internal forecast. And that's includes a 1% drop in visitor arrivals and a 2% drop in visitor spending in fiscal 24.
And you
Okay.
still get to, what was the number you had?
4%. It's actually 4.5%, but
You still get
and
to 4.
I
Wow.
have 13% growth in contracting,
I see. Okay,
and assuming that we can find the workers
right.
and that this state and the counties can get their contracts out the door and continue to compete for federal dollars. My guess is that over the next 5 years, our very strong construction forecast is going to be too low because primarily because of federal and DoD spending.
Hmm.
And a whole bunch of that doesn't matter what happens at DPP.
Right. Right.
I'm been looking at the models that we've been providing input to, and it's surprising for 2024. I shouldn't say surprising, but for 2024, our individual forecasts do not range very much. There's low is 5.4, high is 7.5, with a mean of 6.5. So if we look at our particular inputs into the model, we're pretty uniform in our thinking. Maybe that's just a random event, but anyway, 6.5 is probably on the high side.
So Seth, where do we find it must be in the main booklet, the council's mean forecast for all the inputs. It's in the
It's in the book. You can also find it on the
core
summary of your
booklet.
members' forecast.
Okay, here it is. Table 3. Interesting.
But the numbers I gave you are without consideration for the constitutional refunds.
Oh.
I mean, there won't be any constitutional refunds.
Oh, I see. Yeah, but they took them. That means they took them out of fiscal 23, right?
Right.
Correct.
You say without constitutional refunds.
Right.
Because it really will.
That's weird.
If you bring it down, then like the base is lower for this year by $311 million. If you assume that in which you guys should assume that that's not going to happen again.
Yeah, 325.
So these growth rates would be even higher then.
Yes.
Right.
It's 9.3 billion.
The same handout.
3.5% is 325 million. So we brought down the base a lot, like Dr. Kobe's saying.
So does that mean we need to add back 3.3% to our forecast for?
But
I don't think so.
But we have to factor in the current year.
I don't understand why those numbers are as high as they are in the first place.
Yeah.
So why are we getting a mean forecast of 6.5%? And it's not obvious to me from looking at the growth rates of the inputs, right? The mean forecast of the council has nominal income at 2.5, which strikes me as that seems reasonable. I think the inflation number is maybe a little high, but it's not that unreasonable. It's where is it? I lost it. 3.3% for fiscal 2024. I mean, my forecast is 2.3, 1%. But so even if you take 1%, I just don't understand where we're getting 6.5% from as a mean.
Yeah, I think 6.5.
That's 3.2% real growth.
TPI is going up at 6% according to our inputs. And if you assume some overall elasticity above 1, you know?
Yeah, in nominal terms, so two and a half and 3.3. It's just under 6%, right? So in my forecast, the nominal income is going up at 4.1%.
That's the nominal income for what?
Fiscal
For-
24.
For personal income or for?
Yeah, total personal income, state of Hawaii total, because that's a major input into the model.
Right. And you said your assumption is what, 4 point something?
4 point, almost 4.2, not quite 4.2.
And again, your inflation number for fiscal 2004 is a lot lower probably than
That's
most.
right. It's a full 1 percentage point lower.
Yeah.
And my nominal income forecast, or my real income forecast is 0.7% lower. Because we don't have any job growth in our forecast next year. We have very limited job growth.
Well, it seems like we're going down for with a recession or even a mild recession predicted, and the interest rates going up even further. I think that will restrict purchase of people buying cars, people fixing up homes and whatever. And so I think it will act as a brake to spending anyway.
So our current forecast isn't our current forecast 4.5?
So that's what it says, right?
What says?
Table one.
Table 1.
Yeah, table 1 says current forecast. Oh, it's 5% is our current forecast.
Ah.
But we're dropping the base from 5.5, the current year from 5.5 to 2. And we're not going to have the constitutional refund next year.
Well, you don't know that yet, right?
We're not forecasting constitutional refunds one way or the other.
Yeah, but it makes it, after our meeting today, it makes it more unlikely.
No comment.
So if we assume 4%, without consideration of I mean, this is 4% on a
The
number,
lower base. Yeah.
lower base because of the rebates.
Right.
And if you add back the rebates, your percentage is going to be lower. Your percentage growth is going to be lower. It's going to be less than 1%, I think.
So so I think we settled on 2% for last fiscal year.
Yeah, 2%.
So
Current fiscal year, not last.
yeah, right. So I'm getting 9.92 billion for fiscal 2024 with a 4% assumption across the board.
Yeah. 9.929 or so, 9.93.
Yeah. And yeah, so it's another 500 million out of the fiscal 24 forecast. Almost. So you're taking 300 million out of current fiscal year and almost another 500 million out of next year.
By lowering the growth to 4%.
Well, by the combination of the 2% forecast for this fiscal year and then 4% for next.
Okay. All right. Yeah, I see what you're saying. Yeah, I got it.
Yeah.
Oh, you made a comment that you said the consensus is a mild recession. I mean, are there people think that it's going to be more than mild?
Oh, sure. Yeah, there's also people who think there will be no recession. I mean, there's.
But historically,
It is true that most economists are, if you look at like the Bloomberg survey or Wall Street Journal poll or whoever, the majority of people who are trying to forecast recessions and failing miserably most of the time, the majority of them are betting that there's going to be a recession because they think the Fed's going to overdo it. And I guess the longer it takes to bring the U.S. economy to cause it to slow markedly, it seems like the probability of a deeper downturn grows, right? I mean, if we got another 400,000 or 500,000 jobs in February, or if we ended up adding jobs at a 300,000 a month pace for the next 2 or 3 or 4 months, then people are going to start talking about Fed funds rate of 6.5%. And right, the Fed can stop inflation. And so there are people who are betting that that's the case, that it's going to be hard to bring inflation down. The Fed's going to push rates up over 6%. And when you do that, people will not be buying cars anymore, right? People will be defaulting on their credit card debt, et cetera.
I guess I had a question regarding the economics of it. When we went through the pandemic, I think there was maybe too much money given out. And now I see that a lot of money is being diverted to the war in Ukraine, which means that a lot more effort, and they're spending a lot more money in building more military equipment and everything, which means that a lot of the jobs might not be spent on things that the consumer would like, and maybe, I don't know, what that is keeping the inflation up. And I don't know if that plays a factor.
Interesting. My first reaction would be it's probably not playing, right? But right now, what's happening with inflation is so many of the things that everybody thought were going to be transitory, and then they weren't transitory, partly because of the Ukraine war. They're now showing up as transitory, right? They're starting to go away, like oil, for example, right? So we got the oil shock when we opened back up after the pandemic ended, and the refineries were shut down, and gasoline prices shot up, and then we thought that was going to be temporary. Then we got hit by the Ukraine war, and you got another round of oil shock. But oil prices are back down where they were before the Ukraine war right now. And so many of these transitory pieces are going away. That's what's driving inflation right now. The question is, how hard is it to bring it down further, right? So if let's say we only get down to 4%. Let's say we're too optimistic. Let's say we only get it down to 4.5%, the middle of this year. How does the Fed read that? How high do they push interest rates to try and bring it down faster? That's what's at play. I don't feel like what's happening in Ukraine is necessarily having much of an input. Remember, those are not consumer goods that are being that all that money is being spent on, right? And frankly, right now, consumers are still spending like crazy. Well, that's too strong, but they're still spending, and the estimates that I've been seeing for how much basically people in the top of the income distribution haven't even spent down all of their excess savings yet. You have to go to the bottom end of the income distribution to find people who have completely spent up their excess savings. So that money is still out there. I think they're waiting for the bottom, and then they're going to jump into the market. It's not really savings in the sense of for consumption. It's savings for investment.
Well, I guess my concern is that there seems to be a lot of retaliate. The U.S. has threatened retaliation to China if they send certain, deadly weapons, and China is, also trying to restrict things. And so I see this, this buildup of military geopolitical circumstances affecting the economy also, with what the consumers could buy because we were buying all the things from China. And anyway,
Dr. Sidon?
I think it's important to note that the 4% that if we adopt 4%, and I'm not saying we will, but if that's the case, then we are actually building in a slowdown for the next fiscal year, because without the rebate, 2023 would be 5.4% or so.
Yeah, I would agree. I
So-
want to be sure we're doing the math correctly.
Yeah,
Because
right.
last year, we're subtracting 3.3 or whatever, but don't we have to add it back in for next year? Because we will not have that rebate. I'm looking at you, Seth, since you've got all the numbers. Since we won't have that rebate going out, the fiscal year 2023 is artificially low, right?
right.
So,
Right. So
instead of
fiscal 23
2%, in our forecast, it's 5.3
right.
right,
roughly, right?
roughly.
When you add the rebate back in,
Yeah, 5.3. That's all.
So
And
are
and
we,
we're saying we're going to 4.
We're going to 4, which means to slow
Yeah.
down.
a
in the
slowdown.
underlying- and slow down in the underlying revenue growth of the state.
Yeah, that would imply that you only have 1% growth.
yeah,
At the current
Well-
4%, you have 1% growth over this year with if you add the constitutional refund back in.
mhm.
No, in fact, well, wait a second, that's confusing to me.
What are you talking
Because-
about, Seth?
Yeah, because if you add the constitutional refund back in,
Mhm.
you're dealing with a base of 9.9 billion, basically, compared to 9.5 billion. And our 2024 forecast at 4% would be 9.9 billion. And that's 4% above 9.5, which was,
Artificially low.
I'm
Yeah.
screwing myself up there too.
Yeah, I think we need to get the math right. I think
Well, yeah,
that
but
we are,
I think 4% is okay for the math.
okay,
Well, I don't know. Let me just say 4%. If we say 4% in fiscal 2024, that means we're assuming a slowdown in the natural collections of the state,
mhm.
abstracting from the 300-some million rebate refunds.
So if you guys, let's keep it easy, right? So let's say everything was up 5.5%, right? Which is about taking what you guys have done and added it back in the constitutional refund, right?
Mhm.
So that would give you around 9.87 billion
Mhm.
for this year, right? If you add back in the
And that's what our
constitutional-
forecast was from the last meeting, 9.87 billion,
Yeah,
right?
exactly.
And so if we grew at 4% from there.
No, if
okay,
you grew
or
up
that-
4% from
actually-
your lower base, you would grow from the 2% rate that you're from your new rate. If you grew 4%
Right.
from your new rate, you would have 9.9 billion,
Right.
right? So you're expecting $100 million extra, which is like 1% of growth.
Yeah.
And that's including, that's nominal, right? So that would be
Yeah.
negative 4%, whatever your inflation is, that's negative 3% growth or negative, whatever you guys want to think your inflation is.
I think we basically have to add the 3% back.
So
So
the number that I
that's-
threw out, the 4%, came from a model that is, because it's based on historical data, it's got the lower base.
Okay.
Mhm.
And that is what your model is showing.
And I'm not sure if I would build back in a full 3.3%.
Okay,
What do you,
How
What
much do you want to buy, but add back in, or how many? I can do the numbers for you. You just tell me what you guys want to do and I'll add it back in.
I don't think you need to add back anything. I think we just
Okay.
need to come up with a number for
Christie,
2024.
what are you thinking for fiscal 2024?
You know, the other thing I wanted to mention is that airline prices have really gone up quite a bit. Seems to be going up more and more. And flights, a lot of the airlines have cut back on flights. So I've noticed. And since Hawaii is so dependent upon airline travel, Dr. Bonham, you have different numbers? Or-
You know,
I
we got-
haven't seen any cutback in flights in the seats outlook data.
We got spoiled with those $200 round trip tickets to the West Coast.
Yeah,
Now-
I wouldn't argue that prices haven't
Yeah.
gone up, that's for
Yeah.
sure. And but anyway,
It's not-
so in terms of thinking about it, what the number for the year should be, the base really does mess things up.
Yeah.
Let's see if
If
we
you
can-
add, so if you added 3% to the fiscal year 2024 number, you would still be lower than your previous forecast
Yeah.
for fiscal year 2024. Right, so you're still lowering the base by $153 million.
Mhm.
Yeah, I think the 4% is too low. I know you're shocked to
Too
hear me
low?
say that. Yeah. Because I think you have to keep the 3% in play unless we do have a real slowdown in the economy.
I guess that's what they're assuming, that it's going to slow down in this next fiscal year.
Well, that's certainly what's in our forecast. I mean,
Yeah.
we're
Well,
not, we don't have declines. We just have a pause in growth.
But you guys can already kind of think about what's going to happen, right? So you're going to see July and August, and it's going to look normal, right? So you're going to see something, it fluctuates throughout between 3% and 5% probably, and then all of a sudden, you guys are going to get like these really big numbers until January,
Right.
and you're going to have to think about like, okay, how far do we come down from? I don't know, 9%, 10%, right? Because you're going to put $300 million into 4 months.
Right.
Well, it seems to me that for the purpose of forecasting 2024, we're going to have to take our 2023 number, which is going to reflect the rebates, which is 9.5 billion, correct?
Correct.
Okay, so I think that should be the base. Okay, take that as the base, because that's going to be the reality, basically. And in fiscal 2024, how much is fiscal 2024 going to be compared to 9.5 billion? And if it's 4%, then fiscal 24 is going to be 9.9 billion.
Yep.
And if you're happy with 9.9 billion, then we should be happy with 4%. If you think 9.9 billion is too little, then we're going to have to increase that percentage above 4.
I'm comfortable with 4%.
Okay. I usually am arguing for a lower forecast.
Oh,
But I
yes,
just want to
we've
be
noticed.
very clear that 2023 is artificially low by 300 million. So
We
in my-
Well, but it's
my-
also artificially high by all the other things that were going on in fiscal 2023, right? Like the April collections.
Okay. So you think those sorts of things kind of cancel each other out?
Well, so
Yeah.
let's suppose that the April collections were, they're
They could be
50%
down.
higher than they were in
Yeah.
2019, and
Okay.
right, so that could swamp everything that we're talking about,
Yeah, that is true.
unfortunately.
That is true.
And I worry about the listen to me. I'm sounding like other people on the council. I worry about the particularly real estate transactions, and right. So what we've seen so far is, and we're resales of single family homes and condos across the whole state are within, I'm just going to say spitting distance, but they're getting close to where they were at the bottom of the Great Recession. That's how far they've fallen. And so, the realtors aren't going to be reporting the kind of revenue that they and paying estimated taxes on it, right? We're not going to have the conveyance tax on these properties, and then if you don't sell the homes, then you don't do the renovations. You don't go out and buy new furniture and all the other stuff that goes with housing, and that's resales. But if you talk to the builders, they aren't doing lotteries anymore, and this was, we saw a little bit of a move up in activity when mortgage rates came down to 6.5%, but now we've completely reversed that, and we're right back up at 7%. And I don't think we're going much above 7%, because I'm a believer that inflation is going to come down pretty hard. But anyway, I think there's reasons to believe that the economy is going to slow enough that we're going to get to that 4% number without working too hard at it.
Okay.
But to be fair, Carl, if you really think a lot is going to happen in April, you should lower to 2023. And
well, we did, but
yeah,
maybe we didn't do it enough. But if, we're lowering it in 2023 and then keeping it lower.
Yeah.
So
I don't understand what you just said.
April's not going to bounce back up next year. That's all I'm.
Well, we're assuming 4% for April, basically.
Well,
yes. We're saying the whole year.
Right.
And so,
yeah.
On average, we're assuming 4% for April.
So you threw out 4%, Carl. I think I heard Jack talk about 4%. Any?
No, Carl said it was the point of discussion, and so did I.
Okay, do you guys want to put forward a number?
Well, you were convincing. I'll make
So-
a motion at
So
4%.
so the argument is that the 4% really is about 1%. If you were to adjust the base in fiscal 23.
Right.
Okay. And what I was suggesting is, well, there were other things going on in fiscal 23. Maybe you shouldn't adjust it the whole way. I don't know what the right number is. But that 1%, that's nominal, right? So
Right.
I don't think we should be adopting a 0% real or a negative real forecast. And our fiscal year inflation forecast is
3%.
no, fiscal 2024, it's 2.3.
Oh, you.
Mine. I don't know what the council said. Yeah.
3.35.
Come on, fiscal 24, that's a long ways from now.
Fiscal
If inflation hasn't come
forecast.
down, if inflation hasn't come down, we're going to have bigger problems, right? If we don't have fiscal year 2024 inflation down in the 2.5% range nationally and in Hawaii, we're going to have bigger problems than what the inflation numbers are.
Yeah.
So what do you think would be a good number, Carl?
Well, so if you took so what is the council's inflation forecast? 3?
3.35 or something like that. 3.35 for fiscal 24.
Yeah, and it was 5.25 in the current fiscal year.
Instead of adding the 3% back in, let's add 2% back in. That gets us to a number that's roughly on par with a 2.5 or a 3% inflation. So we're not talking about real decline.
Yeah.
So that would be like
so-
5% or,
Jackson.
Yeah, I'm. Okay, I'm a bit confused here. So 4 is nominal that we had. So what are you suggesting for just a plain nominal number for 2024?
Oh, so so if you added 2% back in, you'd be at 6 nominal.
We. 6
Without,
nominal,
but with the
Six
base, with the
nominal,
base
half-
adjustment,
6 is nominal, half of which is inflation.
and half of which is the previous base adjustment. Right, 3% adjustment for fiscal 23, and then 3% inflation, you're at 0 real.
Mhm.
And 0% growth, that's what you're saying, mild recession.
Well, yeah, that's pretty weak.
I think your point about April though is a good one. And Seth, your point also, I think there's a big uncertainty on what we are actually going to receive in April. And it will be interesting because we're looking at percentage changes. But if that number comes in real weak, what we submit is an actual dollar number, right? Or do we?
Yeah,
Yeah.
those tables with all the dollars in them, that's.
Yeah. So the percentage change, we may think that 6% or 5% or 4% is a good number, but if April comes in very weak, that percentage will be higher, right? Because we're actually submitting numbers and not percentages.
Yeah, but I think for an out, I don't want to necessarily call this an out year forecast, but it is a
Yeah.
slightly out year forecast. I think we need to look at it on an annual basis and not just month by month, because if we're saying like 4% growth for the year, the monthly growth rates are going to be all over the place,
Right? Yeah.
including the April one.
Mhm.
But I do worry about, I'm still not sure whether or not this April 2022 number of 1.4 million,
Billing.
how
yeah.
permanent that is, whether,
Right.
and whether or not that's just kind of an aberration in the big picture of things. And if there's some return to normality, and we've said -1% for April of 23. But if you assume 4% for April 24, then you're back up to 1.4 billion.
Yeah.
So,
We could see a swing of 300 million in April. That
yes,
could be our 3.3%.
Yeah.
Because April's capturing, the prior year's
Capital
tax,
gains.
because you have to pay any deficiency that you didn't pay for the prior year's taxes by the extension. And it's also capturing the first quarter of 2022. And then the indication so far, I'm a little concerned, like if said they're saying conveyance tax is down 100 million, and then inflation is lower than we expected. Because inflation it goes into number, right?
let's say inflation is 2.5%.
Excuse me, Jack. Inflation also affects our estimates because we build in.
It affects everything.
So just remember, prices aren't falling in most categories. Inflation is lower. That doesn't mean prices are going down, but
And
Yeah.
prices have been going down in Hawaii, whether it's gas, other things.
only in some areas. Gasoline,
Yeah, well, that's
Yeah.
up and down.
Mm. Okay.
So anyway,
so pick an inflation rate of
I kinda like-
2.5%.
Come up with a number.
I kind of like the 4% because, when you look at it, it's higher than 2.1% for fiscal 23, but really fiscal 23 was all about 4%, 5% growth rate.
Mhm.
And then that aberration called the rebates. And so if we assume 4% for 24, we're actually assuming a slowdown in collections. And in terms of real collections, if you assume 2.5 to 3% inflation, we're talking about real growth of about 1% or a bit more.
So would you like to make a motion?
Well, I'd like to make a motion and not look like a fool, so.
Yeah.
So I'll make a
Look,
motion.
there's enough noise and enough still pandemic craziness that was affecting fiscal 2023 that we really don't have something to grasp onto. We keep worrying about whether the base in fiscal 2023 is distorted or not. Well, of course it is, right? We know at least one item that is distorting that.
Sure.
But there are 5 others.
Yeah,
And
I agree. So Jack made a motion at 4, is my understanding. Any second?
I'll second it.
Oh, who seconded it? Was it Carl or Wendell?
I'll let Wendell have it.
Okay, Wendell.
Thanks, Carl.
Anyone want to discuss fiscal 2024 and the motion at 4% any further? Okay, let's take a vote if there's no one wanting to discuss it further. Vice Chair Niwa,
No discussion, yes.
Dr. Sadra, that's your motion. Yeah, Dr. Bonham,
Yes.
Councilmember Maynard,
yes,
Councilmember Hayashi,
Yes.
Councilmember Lee,
Yes,
and the vote carries unanimously at 4% for fiscal year 2024. Okay, any discussion on the following 5 years or 5 years? Let's go 2025 to 29.
I move that we maintain the same forecast that we had before.
I second that motion.
Anyone want to discuss the motion?
I think obviously there's going to be a lot of changes in tax laws that, even if we were really good about forecasting, the ground on which we stand could shake a lot between now and then.
yeah, because it'd be really interesting on the standard deduction once that gets rehashed and if it's going to be indexed somehow. That's a big change.
Mhm.
Just for the record, I totally disagree with the council's decision to do bottom of the line forecast, because you really do take away our CRP's ability to actually put in the exact numbers. And that's why you guys get into these kind of weird things about, oh, if we subtract this one out versus we subtract this out. But you guys don't have to even think about the constitutional refund. You could have done the above the line numbers and we would have addressed everything for you. So just throwing that out there. It's kind of been a long time thing I believe in. So for example, the standard deductions and all the inflation stuff can be very difficult to do. My office spends months trying to figure that out, and then we would put in an exact number, and it's a lot easier to figure that out versus you guys, six of you collectively deciding how that would affect the percentage rates over 1 hour.
Noted.
Yeah, that's all. Okay,
You don't
But
find it
but
entertaining?
I'm not really sure that. So what would we have done different this time? We would have stuck with
What we had.
5.5% above the line. But we didn't have an above the line forecast for this fiscal year,
No.
did we?
No, we
So
didn't.
if you go on to page probably page 8, table 5B, something like that. It's very difficult because you guys were doing below the line before, so we had a bunch of stuff before, but you can see where we do provide a above the line number
Right.
that accounts for all of that, right? So you guys, if you guys just wanted to focus on the above the line number, you could do that, right? And then we would focus on the below. I think there would be some kind of transition time because you're basically moving from one baseline to another baseline, so it would mess you guys up a little bit, but it would allow you wouldn't even have to worry about the constitutional refund, for example.
Can I suggest that we put this on an agenda item for a future meeting when perhaps we have more time and have a really explicit discussion about this, because I think it's a real important step for the council if we do it that way.
It'd be some
So just
consistency.
from a historical perspective, the council has always got bogged down in the below the line stuff.
Yes.
So and it may be, in this case, it's a lot less messy. And there wasn't any particular reason for us to get bogged down in it, right? But when we're thinking about high-tech tax credits, and I mean, it's something where you're really guessing what those numbers are going to be, that council has spent hours and hours debating them.
Well, even straightforward ones like deferring tax refunds to the next fiscal year. You remember those gave us all sorts of headaches.
Yeah.
So I
remember.
think Seth's point's well taken.
Yeah.
But I also agree with you, Jack, and we
So
should
we have
keep.
nothing to argue about.
Right.
Oh, go ahead.
Oh my God, you guys could do your meetings in 20 minutes because you would
Yeah.
really talk about the economic fundamentals of the Hawaii versus like accounting tricks. Heaven forbid.
And the good thing about that is that the above the line forecast, there's no way for you to know what reality actually is.
Yeah, if you're right or wrong.
So we have a motion.
Yeah, we can't be judged against it.
Yeah.
Motion that's been seconded, and we have the last 5 fiscal years to keep it the same growth rates. Any further discussion on that topic? Yes, Carl.
So, not to make this more complicated, but 3.5%, that's, so I would suggest that the long-term average inflation rate's likely to be about 2.5. It's not 2% because the Fed's target is not for the CPI, it's for the personal consumption deflator. And so with the CPI, that's much closer to 2.5%. That means we're talking about a 1% real forecast. Now, I'm probably the one who suggested this in a previous meeting, but that reflected an expectation of slowing economy that you know, and a recession that may or may not come. Anyway, the point is that 3.5 might be a little on the low side. And I recognize that we don't have, I mean, so if we were literally doing above the line, like Seth suggested, I don't think we would pick a 3.5.
But yeah,
I think 4 would make a lot more sense. So we'd be talking 1.5 real, which is actually, now I'll argue against myself. The average growth of Hawaii from peak to peak, Hawaii real GDP was about 1%. From 2007 to 2019. So if you think we're headed for that same kind of anemic growth, punctuated by a great recession, then 1% makes good sense.
well, we have capacity constraints, so.
Yeah, I think 1% real growth is okay. And
Yeah, I think it's worth talking about. So
And historically,
it's definitely plausible.
yeah,
really try to pinpoint out years because it's so much uncertainty.
Well, that's why we settle on these benchmarks or these.
The longer term growth rate that I use for like kind of trough to trough and is like actually in nominal terms is 4.8% or 4.5% for the general fund growth.
Any further discussion?
So of course it matters dramatically what sample periods you use.
Yeah.
Totally.
Right. If you're
and also like, again, this is why it'd be super hard. If you did inflation indexing, I would take that 4.5% down.
Okay.
Right. And get much closer to the 3.5%.
Yeah.
I think that's one of the reasons why the bracket creep is one of the reasons why our tax revenues tend to go up a little bit more than our economic fundamentals do.
This could be a discussion item next year at this time when we're,
I agree with Jack. I mean,
we know what the rules are.
Dragging on and on. So we have a motion that's been seconded. Anyone want to say anything more at this point? Okay, take a vote. For the out years at 3.5%, beginning with fiscal year 25 to fiscal year 29. Vice Chair Newell,
Yes.
Dr. Siderall,
Yes.
Dr. Bonham,
Yes.
Councilmember Maynard,
yes,
Councilmember Hayashi,
Yes.
Councilmember Lee.
Yes.
The vote is unanimous for 3.5% from fiscal year 2025 to fiscal year 2029. 29. Okay, I think the next up is the BNF, right? Budget and Finance.
Donovan.
You there, Donovan?
Hello.
Hang on 1 second. Okay.
He wasn't expecting us so fast.
So fast.
Good afternoon, Chair and Council members. My name is Donovan Chun, and I'm with the Department of Budget and Finance. We have provided you with a report of the revised projections of general fund non-tax revenues, non-general fund tax, and non-tax revenues since the January 5th meeting. The revenue estimates were prepared by departments in February, and were based on point-in-time assumptions made by program and department staff. Our report does include a summary of significant changes, and I will highlight 2 items. On table 5, hang on, I'm going to share my screen. Table 5A, I guess. Under other than, this is on other than special fund non-tax revenues. Under charges for current services, there was a net increase in fiscal year 23, which reflects an increase in refunds, rebates for prescription drug plans, and network and performance guarantee payments on medical and dental plans for from insurance carriers to EUTF. In FY23, that amount was 52.4 million. And under non-revenue receipts, the decreases in fiscal years 25 through 29 reflect revised projections in employers' annual required contributions needed for future costs of other post-employment benefits for state, charter schools, city and county, Honolulu Board of Water Supply, County of Hawaii, County of Kauai, County of Maui, and County of Hawaii Department of Water Supply for employee health benefits. And this is a revision based off of a revised actuarial report. And that ended up, the largest significant one was in FY28 of adjustment of 98.8 million. That is the 2 items. Yes.
Sorry, while we're on this page, do you know why between fiscal 23 and fiscal 24, the charges for current services dropped by about 160 billion, 150 billion? Okay.
Charges for current services.
A million, sorry. This is table 5A.
Yeah,
So you're
that
running along at about 370 million, and then all of a sudden it drops to 218. I'm just curious what's going on.
You know, there was not a single specific thing that changed, but it could be accumulation because there's thousands of elements in this report.
Yeah, I'm sure there are.
I could double check in that. So are you looking at fiscal year 24?
Compared to fiscal 23.
Oh,
So charges for current services are 374 million and then drop to 218 million.
hang on a second. Let's see if I can pull that.
No, I don't want to drag this on. I just,
Okay,
you know,
I will
if you
take
find
a
it,
look
send
at
me
it.
an email or something.
Okay,
Okay, thanks.
I can do that.
Thank
Yeah,
you.
could send it to Seth and he can distribute
Yes.
it.
But Donovan, sorry, but that also reflects, that 374 reflects that adjustment that you talked about previously, right? The 374 was increased by an adjustment you mentioned, I think, for the insurance.
Yeah, so the rebate, okay, so that is the significant part. The rebate amount back to the state was that 52.4, so that's a bulk of it. But there was also adjustment in 24, which does not include the change in the projected amount for that rebate. It's kind of like based off of their experience from the insurance carriers. They always make a projection, but then there's always an adjustment after the fact. Yeah.
But there's still about 100 million that's unaccounted for. I think that's Jack's point, is that it drops by a significant amount. So.
Yeah, I will take a look at that.
I mean, it's positive. It's a reduction in the cost, right? And it stays at that level going forward.
Yes. At that, yeah, and then they didn't update their out-year projections after that. So I
Maybe
don't
it's like our 3.5%.
yeah, something like that.
This is on the expense side, though, not the.
Yeah.
I mean, it's special funds too, right? This.
Yes, and that actually is see, my coworker is texting me. There was no out-year estimate, and then sorry, let me look. I lost his text to me. Yeah, there was no out-year estimate change. That's why. Okay, we can take a look at that again.
Thanks.
Oh, and then the actual, that 52 is an actual. That's why too.
Mhm. Okay.
Any other questions?
I move we accept the report.
I'll second.
Okay. Vote on accepting BNF's report. Vice Chair Newell,
Yes,
Dr. Siderhoff,
Yes.
Dr. Bonham,
Yes.
Councilmember Maynard,
Yes,
Councilmember Hayashi,
Yes.
Councilmember Lee.
Yes,
Okay, so the BNF's report is approved unanimously. Thank you very much, Donovan, Mr. Chen. And if you could get back to us, if you could email Seth with, your, you can go back and check what the answer is.
I will.
Thank you. Okay, next final item on the agenda is the scheduling of the next council meeting for general fund in May. So when is the report date? Is it June 1st?
Correct.
June 1st. And the Memorial Day weekend this year is what? It's on the
29th.
The 29th.
29th. That's a Monday, right? The 29th.
May I suggest May 16th? We have all the information. Tuesday, May 16th.
Works for me.
That's Dr. Bonham.
I will not be available from Tuesday, May 16th until June 1st. So if you want me to participate, let me double check my calendar real quick. I
How about May
think,
15th?
how about the 15th?
It's the 15th.
let me see. I don't know when I'm flying. May 15th.
Dr. Kobe, is that it? Give you enough time, May 15th?
Yeah.
Mhm.
I'll be out of state that week.
And
The whole week.
you won't participate by Zoom or?
I'll try to get on Zoom. We'll see what my connectivity is like.
the 15th is fine with me.
Yeah, that's,
Carl, does it work?
For some reason let me double
so-
check. I think it works. And I need to,
It being
Huh?
Monday or Tuesday,
Monday.
15th is a Monday.
Yeah.
right? He said it, and I want to know what it is.
the 15th.
15th. Okay.
Monday.
Give me 1 second and I'll tell you.
Oh. Okay, yeah, I think I should be okay. So- Where are you going to be, Wendell, on the East Coast or?
No, I'll be in taking my dad for his birthday to Las Vegas.
Okay, so
I think we fly out that day.
it'll be 3 hours. 3
Good
hours
reason.
Yeah.
that time.
Yes, the 15th is okay.
Okay. So it's the 15th.
Let's see, 2 o'clock is going to be 7 o'clock my time, 6 o'clock my time. Okay.
Because I'm going to be in DC, so that's 8 o'clock on the East Coast.
Yeah.
Yeah, so 2 o'clock on the 15th, May 15th. Is that good with everyone?
Yep.
Yeah.
Yeah, we'll be in daylight savings time, right?
Yeah, yeah.
Starting this weekend.
Okay,
Hmm.
so the next general fund meeting will be Monday, May 15th at 2 p.m. Hawaii time. Okay, thank you, everyone. Very good discussions. And we had all unanimous votes, which I'm happy.
Yeah, so that means there's no uncertainty.
Yeah.
Yeah,
We're all
we're all,
wrong. That's
we're
what
all
everybody-
uncertain, that's why.
Okay,
Kurt,
all
I'll
right
get
except for the
you
wrong
the
reason.
information today.
Okay.
Tomorrow's my last day in the office, so if you get it back to us tomorrow morning, that'd be great.
okay, yeah, if you can. Yeah, I'll get it back to you by tomorrow morning. If you can get it to me by like about 6 p.m.
Yep, I'll get it to you within the next hour.
Okay, that sounds good.
Great, thank you.
The
Okay.
last you were in the
you.
office for a while or forever?
3 days. 3 days. Yeah,
Okay.
yeah.
Okay,
Okay, thank you, everyone.
Thanks,
Bye-bye.
everybody.
congratulations.
Okay, see you at the next meeting, May 15th,
Okay.
2 p.m.
Okay, bye.
Bye-bye.
Thank you.
Thanks, everyone.
Okay.
Bye.
Bye.
Thanks, bye.